Turk is founder and chairman of GoldMoney. James, there's a Citigroup note floating around in the market suggesting that they believe gold's going back to $2,000 or going to $2,000 an ounce over the next 2 years. My point would be, given all the bad news we've heard, shouldn't gold be higher than where it is now?
Well, it depends which currency you're looking at. It is at record highs in terms of the British pound, Canadian dollar, and other currencies. If you look at it in dollar terms, it's not doing that badly. It's down a little bit, but it's fallen a lot less than everything else, which is, I think, remarkable given the deleveraging that's going on.
I understand the point you're making, but if you look at the flow of news that we've had in the last 3 months or so, you would have thought that gold, at least as a safe haven and a port in a storm, would still be higher than it is currently.
Well, it's a two-step process. The first step is the deleveraging, and then the second thing is, once you get liquid, where do you put your money? And I think what we've seen now is a base being built in gold, and I think we can expect higher prices next year. After all, there's very little incentive to hold dollars. On an inflation-adjusted basis, interest rates are negative. You lose purchasing power by holding just about any currency these days. So gold is attractive, and there's no counterparty risk when you hold gold as well.
But is it really counterparty risk? I mean, it seems that we're looking at, or whether we're looking at deflation, or whether we're looking at a huge slowdown in the economy, whether we're looking at inflation even, that gold is always kind of being said, well, that's the asset class to be in, despite, you know, the very mixed signals that we're getting on some fronts, whether it's deflation or inflation. Well,
gold responds to monetary problems, regardless what the monetary problem is. And, you know, we've been in a period of trouble. If you look over the last several years, in 7 years, we've had gold up 17% per annum on average against the U.S. dollar, 15% per annum on average against the British pound. I mean, it's one of the world's best performing asset classes this decade, and there's no reason to suspect that that's going to change anytime soon.
I'm curious, because you mentioned there that if you're going to pull money out, what are you going to do with the liquidity of just the cash?
Yes.
My concern here is, how about the other commodities? Because they're all competing for the same type of thing. Do you see that any movements in the other commodities are going to affect gold?
You know, that's a good question. I think that depends a large extent to whether the deleveraging is over in the hedge funds. I think we've seen a massive sell-off in commodities because of that deleveraging, and we now have to get back to the real economic demand for those commodities. My guess is that gold and other commodities next year are going to go up pretty much together. It's interesting, one of the things I look at is the price of crude oil in terms of gold, and while it looks expensive in terms, crude oil looks expensive in terms of dollars or pounds, an ounce of gold today buys the same amount of crude oil it did 50 or 60 years ago. So gold holds its purchasing power over long periods of time, and that's what makes it money.
James, good to see you this morning. Thanks for coming in and
updating
us on the story. Yeah, James Turk with us from GoldMoney.